right, I've got 11:01, so we're going to go ahead and get going. Welcome, everybody. Welcome to our first quarter here market update, and I want to welcome everybody. Just a little bit of housekeeping. We do have the chat open as well as the Q&A area, so if you have any questions that you'd like to pose to the two of us, please include them in there, and we'll address those most likely at the end. I've put in a file or a handout in the handout area as well, and it's called the 2025 What Issues Should I Consider During a Recession or Market Correction. And this will give you a little bit of a checklist that you can go through that just asks a few questions of what you should be thinking about. Are there specific issues around debt or traditional 401ks and IRAs, those kind of things that need to be addressed whenever we have a market disruption like we've had so far this year, that I hope you'll find helpful. So again, that's in kind of the files and handout area. So if you wanted to grab that, you certainly could. Welcome. Will and I are in our cozy little PrairieFire studio today. It looks like I got the focus and you got the unfocus. You might have to move up a little bit. So anyway, wanted to welcome everybody here. We've had a crazy start to the year. It's been a lot of unusual events, things that we haven't seen in the past. News and changes are coming quickly, more quickly than I've seen in a long time. And so when that happens, it can create a lot of market upset. We want to talk about that today, talk about some of the things that are going on geopolitically, and just tee everybody up as to what we're thinking, what we're hearing, and what we're planning to do as a result of all the challenges. So I'm going to kick up the slides here. Just a reminder again that you've got Q&A and chat that you can lob questions into if you have any. So let's get to our slides. Actually, let's do a poll. What do you say?
Sure.
All right. So I'm going to start a poll for everybody. And it says, do you think that we're going into a recession in the year 2025? So recessions are funny. What they mean is 2 quarters where we have negative growth. Rick Santelli, I heard on CNBC this morning, said that we had 2.8% growth. I think it was 2.8, somewhere in that area, revised for the fourth quarter of last year. The thing about recessions is a lot of times you don't know you're in them until they're over. So you can maybe judge from the way things are going right now if you think maybe we're in a recession or heading to one. But, oh, I forgot to publish it. Sorry, guys. All right. So the poll is out there, and it says, do you think that we'll go into a recession here in 2025? So we would love to hear everybody's input. And again, we don't always know. We don't always know if we're in them or what's going on there, but we always wonder because it does have a big impact on the markets if we're in a recession or going into one. So it's a bit of a split, but 2/3 of you think that we are going into a recession and 1/3 say no. So we've got a bit of a mixed crew. That's not unusual with my polls. We usually get a variety of responses, but first of all, thank you for answering. But yeah, we've got kind of a mixed bag, and I would agree. I don't ever try to predict recessions because you just don't know. And like I mentioned, they tend to show up after the fact when you get the data and all that. So, and does it really matter? Sure. They have a big impact on markets. They usually mean a lot of things are slowing down, unemployment's going up, all of that. So we'll discuss some of that as we get going here. All right. So 2025, it's been chaotic. Would you agree with me, Will?
Very chaotic, yes.
Thankfully, it's been pretty quiet here at PrairieFire. We're just getting everybody through tax season, but the markets have been definitely chaotic. Lots of changes, lots of things coming very quickly. So here's our disclosure. Some of the stuff we want to talk about today. Quick market update, kind of talk about the things that are going on in the markets. Inflation remains a topic of conversation that we have to discuss. The geopolitical events out there. I've got a report from BlackRock that I want to talk about when it comes to geopolitical risk and things that are happening around the globe. The velocity of changes in Washington and how we deal with that. And that all leads to volatility. And once again, how do we manage that, not just in our investments, but in our brain? Because it can really mess with you when you see big 1,000, 400, 500, 600 point moves in the markets, generally on the downside. And what do we do about all that? And then, of course, make room for some Q&A. So, all right. When we looked at the outlook for this year, my first insights report from this year was about the moniker of Uber, that we might have some uncertainty, that some of the boring sectors in the markets might reemerge, that earnings would probably flatten out a little bit or maybe diminish some. And then the verdict was still out. Are we in the roaring 2020s or not? And so now we've had a first quarter here to kind of assimilate all of that. And it looks like a lot of it's kind of come true. We've had a fair amount of uncertainty in boring parts of the market. So Will, when you take a look at this chart, tell us a little bit about what's happening here.
It's like Matt said, a lot of volatility and uncertainty to kick the year off, and you're seeing that in the markets, specifically with the Magnificent Seven. That's gonna be your Apple, Microsoft, Google, Nvidia, all the big tech names that have done so well the past 2 years. They're getting it on the nose, and that's just because they're priced so high that any little hiccup in the market or any uncertainty that gets fed in, they're going to get hit the hardest. And then the dark blue line, the second line, is the S&P 500, and you can see that's down a little bit too. I think a big part of that is the Mag 7 dragging it down because they make up about a third of the weighting in the index. So when the Mag 7 comes down, the S&P tends to follow. And then the light blue is international stocks. And I think investors are looking outside the U.S. for opportunities, since we do have a lot of uncertainty coming from Washington and other areas, that they're looking elsewhere. And that's why international stocks have been performing well this year. I don't think they've done poorly. They've just been overshadowed the past few years by big tech and the Mag 7, because the past 2 years, those companies have done so well. And then the green, the best performer on this chart, is gold. Gold's considered a safe haven asset when there's a lot of uncertainty in the markets. A lot of people getting scared or nervous, they pile into gold to protect themselves. So that's why we see gold doing well so far this year.
It's crazy. I haven't seen a chart like this in a long time, where we've seen, especially, it's been at least 15 years since international stocks for any period of time have outperformed the U.S. And those rotations can be blips on the screen, or they can be what we'll call a secular move. So where it would be all of a sudden we have a sea change where international begins to do better. It's been a tough area to invest because they've just been so sluggish. You've had a huge, long downturn in Japan. That's a big part of this index. Europe, as they've gone through Brexit and all of the political challenges across the EU and the challenges that came after the Russia-Ukraine war started. You just haven't seen them do very well in a long time. And so now, with the tariffs and the trade wars, you're beginning to see other nations begin to reemerge in at least their companies that work inside of there. We're also seeing a wholesale shift in the way they're dealing with their energy issues, because after the Russia-Ukraine war started, they're learning they don't want to be dependent anymore on Russia for anything if they can help it. And so a country like France is beginning to build nuclear, their own energy stuff. I mean, it's been a big change that we haven't seen in a long time. Recently, Will went to a conference in Dallas that I made him go to. So that was an investment conference hosted by Sanctuary, and they bring in a number of, highly skilled portfolio managers, economists, a lot of people that know a lot about crypto and some of the changes that are going on in the world writ large. But there was maybe a couple themes, Will, that you talked about with me and with some of our folks along the way here that you took from that. Would you mind sharing those with us?
Yeah, so a lot of them were quite bullish, saying that we could have another strong year, and we very well could, but we're not seeing that quite yet. But they did bring in a couple people. The guy who created one of the gold ETFs, ticker GLD, he was there. So they were very bullish on gold, and you can see so far this year it's done very well. And then they also brought in a couple of crypto specialists. Now, we're not going to pile you into Bitcoin, but they were bullish on crypto. They think it's here to stay. It's going to be used in the future, but we don't quite know all the details to that yet. And then as far as where they like to invest right now, definitely infrastructure was the biggest theme, and I think we'll talk about that in a little bit here. But just the whole build out of data centers and the whole energy situation with AI. These data centers take so much electricity, so much water. Look into alternate sources of energy like nuclear. All this stuff has to be put into place for this AI, trend to continue and to be sustainable. And then if you're local in Des Moines, you see the Des Moines airport. That's an infrastructure move as well. So Matt and I think that trend is going to continue for the next 10 years or so. So those are the big ones.
Yeah, definitely. So we were joking a little bit this morning that everything they said was going to happen this year is the opposite's been true. So there you go with prognostication, a good lesson to learn there, that the predictors aren't always right by any means, and you've got to be ready for a range of outcomes because you just don't know. I thought this was interesting, just looking at the markets have really changed over the last 5 years after COVID. The world has changed. I read another article this morning about life post-COVID, where we don't go to lunch really anymore like we used to. A lot of the habits that we had socially have really, really changed. And I thought this was interesting, and it proves when we're in times of volatility, or when people are saying, for instance, AI is the only place that you should be investing. This is a good look at what, an investment trend that took place during COVID that went crazy, but then where we are today. I show you this. So it's Peloton versus Amazon. Amazon's been steady since the tech wreck in '02. They've been a steady growing company. We all know Amazon. We are certainly good consumers at our property, at our house, and in our business as well. And then you can see Peloton, which was really a COVID stock. It was one that people were piling into, buying a lot of their product. And now you can see it's down 70% back to those days. And I just show that to say, whenever somebody's saying we need to go all in a certain area, you need to be careful, because this is what can happen. You can have a trend where something seems, I think back to Zoom and Robinhood and all of those kind of crazy stocks that were going during that period of time. And we could show you their charts, and very few came through it unscathed. And it didn't have a steady business model like Amazon has, which is now up 110% since COVID. So as we're moving into times of change like this, where it's AI, it's tariffs, it's lots of new things that you're hearing in the market, and everybody's saying, boy, you're really missing out if you're not doing something. You want to be careful, because it usually means something like this can happen, where diversification and going with solid businesses can take you through good and bad times. Sometimes a company's fortunes really do change overnight, like they did for Peloton. Investors lucky enough to own their shares still need to go back to the basics of what gives them value, decades of future cash flows. It's hard to argue that a price gain reflects an opportunity that's big and sustainable. The next step is clear. Take the money and run before others figure out what to do. And Peloton was a good example of that. And I'm seeing that kind of same hysteria in AI. And we saw it then as we've seen those stocks decline 13% here year to date. This is kind of what happened. So I'm not saying we don't want to participate, but it's definitely not one of those all eggs in one basket scenario. Next thing we want to talk about is inflation, because it's a big deal. And inflation drives all of our prices, what we're all paying. It really impacts the consumer mentally. I usually use gas prices here is one that's really in your face all the time. When you drive to the local gas station and see that it's $4 or $5 a gallon, it really impacts. I'm not going to travel. I'm not going to go out as much. I'm going to start using my bike again to go to the grocery store. I'm going to spend less when I'm at the grocery store. It just has a real mental impact on how we as consumers behave, and how we behave as consumers drives a lot of what happens in the markets, and how the consumer is doing determines a lot about how our economy grows. So as we can see, as we peaked out in 2022, it came back down. It's been very level ever since as far as the inflation rate change. So the story here is that inflation, as I mentioned in a couple of my newsletters, is very personal. Some people have really been impacted by it because of their homeowners rates going up, or they buy a lot of eggs. Eggs seems to be the bellwether of whether we have inflation or not, but it's showing up in different areas. It appears to be stable for now, but this would be a big concern if we started to see inflation go back up, because that would mean that the Fed would need to raise interest rates again. And that then would be also a challenge. So the 30-year mortgage rate right now is 6.5%. If you get our weekly newsletter, each week Will puts in his Will's Weekly what the mortgage rates are at. This is obviously something that's very also in your face. If you're wanting to buy a house, if you've been waiting for rates to come down to do that, as you can see, while they've come down, they by no means go anywhere near they were if you look at the beginning of this chart back in July of 22, when we had free money. It was, a lot of people that are on this call probably have mortgages below 3% or at those. So why would, people don't want to move. They don't want to make any changes when rates are at this level. And my only prognostication that I'll give you today is I don't see this changing much, because inflation is stabilized, rates have stabilized. Banks aren't anxious to bring rates back down. But I would say this is a big policy provision that Donald Trump wants to come down, even more so than the stock market. He watches interest rates. And that's why he's always leaning on the Fed, saying we should have lower rates for X, Y, and Z reasons. My guess is it will remain relatively stable. If inflation goes back up, the Fed's not going to have really any choice but to raise rates. So if you can get mortgages and you're thinking about buying them now, waiting around for a lower rate, I don't think is a great plan. but it's just one of those areas that remains volatile like the rest of the markets. All right, so geopolitically, BlackRock puts out a report of the top 10 geopolitical events. Right now, they rate 6 of them as high risk, and this would vary from the trade wars that we're beginning to move into, regional war in the Middle East, some sort of strategic U.S.-China conflict, global technology decoupling, where we're seeing who's going to be the leader in AI. China wants it, we want it, how that all shakes out. A major cyber attack is also a high risk, and a major terror attack. So this is not a report you want to read before you go to bed because you're basically scares the crap out of you of all the things that could happen. But there is no question that geopolitical noise is definitely out there. These are the type of events that tend to lead us into a recession and or cause a big correction in the stock market. The trade war has been the big one that's caused this most recent challenge. And so what we've seen is that the threat of tariffs, not necessarily the implementation of tariffs, have created a lot of ups and downs in the market. It's impossible for me to give you a forecast on what the tariff thing means because it's impossible to know what's actually going to be enforced. You all know what I'm talking about. There'll be a threat on a Monday and then a backing off on a Friday. Think of a company like Walmart. They get 60% of their goods from China. If there's going to be a 25% tariff on everything from China, that's going to have a huge impact on how many people they can hire, who they have to fire, what they're going to buy, what they're going to not offer anymore, and are they going to pass that tax on to the rest of us as consumers? You can see where it creates a lot of difficulty. The market hates uncertainty. What it's always trying to do is out the next 6 to 9 months, figure out what companies will be productive and which ones won't. And do their stock prices need to be adjusted as a result? And that's where all the buying and selling comes from. So you can see why we've had this kind of noise and why we've had all of this back and forth in the markets. It's because of this. There's just companies can't plan in this current environment at all. It just creates a lot of angst and noise. Fiscal policy changes coming quickly. The market hates uncertainty. I'll say it again because it's still as true as it was on the last slide. The challenge here is what's going to happen. So let's kind of move into what we're watching and what we really want to see in these markets, and then a couple ideas on what I think we should be doing. So the Fed meeting and the notes that they leave from those meetings will tell us a lot about what they're thinking. Well, I take that back. It'll tell us a little about what they're thinking. They love to be very vague. I don't blame them because the market really reacts to the things that they say, so they want to be careful. But we will be watching if they're planning to raise interest rates, lower rates, or stay the same. Inflation and employment. If unemployment begins to move up because of, it's pretty easy to see in the headlines that companies are laying off. Locally, we're seeing Wells Fargo lay off. We've seen other companies do the same, John Deere. And I think as we're moving through the year here, companies are beginning to trim out, excess where they can because they want to be smart because once again, they don't know. But if unemployment was to begin to go up and or inflation was beginning to go up, that would cause us to really put on the brakes as far as portfolio policy, raising cash, those kind of things. Of course, the global developments, the big change in energy markets that Will talked about, we believe is a secular trend, a long-term trend. We're not going to try to time that in the midst of all of this back and forth right now. We think infrastructure, the changing of the energy grid over the next 10 years is one of the most good investable themes out there. And that's what we're trying to implement into our policies. We're not going to let the day-to-day noise change that because that is a long-term trend that we think will continue. We're moving into the stage of the Trump presidency where they're going to have to get congressional approval for some of the changes that they want to make, whether it's DOGE initiatives, whether it's tax policy. A lot of the things that have been implemented via executive order are coming to an end because now it's going to require a congressional approval to move forward with some of these things. The Tax Cuts and Jobs Act is going to have to be revisited because it expires in the next year or so. And so that will become front and center on Congress. Trump has asked for a big, beautiful bill that will bring all of these things together at once, along with his other legislative priorities. I guess we'll see how that goes. But things are going to slow down as a result of this, in my opinion, because you can't do quick tariff moves, all that kind of thing like you can once it has to go through Congress. It's a meat grinder, and it's that way for a reason, to get a lot of input, make sure the best bill possible comes through the Congress and the Senate. And so let's stay tuned, but we think that's going to be something that we definitely need to watch. And then whenever there's volatility, it creates opportunity. The Mag 7 selling off 15% to me isn't a great opportunity. It's a decent one, but you got to look then at the individual 7 components. Meta's up, 5 stocks are kind of sideways and down slightly, and Tesla is down dramatically. And so the Mag 7, I believe, is going to bifurcate. You're going to see companies inside of it do well and others not so well. And then the downstream companies like Palantir and some of these others could continue to do very well as they supply things to the AI infrastructure that's beginning to grow rapidly as we move through that. But it's also going to create some opportunities in other areas. One of those, I believe, moving forward along with infrastructure is dividend paying stocks. So we have labeled these. I don't know if Will wants to take credit for it or not. We're calling the PrairieFire dividend darlings. So doggone it, that's what we're calling them. But these are 10 companies that we believe or that we know have paid historical dividends, have never lowered their dividend, have strong balance sheets and a good ability to move forward. Think of Coke and McDonald's, a couple names in there. You'll recognize all of them most likely that are in this name. And we monitor them regularly and make changes as needed. But we believe dividend payers can remain price stable and those reinvested dividends are very attractive. So you can see already year to date up 6%, and that does not include any dividend reinvestment that you get from these. So you'll hear us talk about this throughout the year. We think this is a good spot to take advantage of what's going on in the world right now. All right, let's go to Q&A. Let me find. I'm in the chat and the Q&A. If anybody has anything, please throw it in there so we can address any questions that you have. All right, we have our generally quiet crowd. We love it when we see you all in person because you're very good with your questions then. We understand in the internet age, maybe asking questions isn't the thing to do, but we just believe that we want to be here to help in whatever way that we can as we go through a times of change like this. And so please reach out if you do have questions. Laszlo Berigny he's a stock market analyst, I guess is what you'd call him, but he's been in the business for 50 years. He just promotes a lot of wisdom. I require Will to read this every month that it comes out. I put it on his desk and put on highlights and things like that. I've just learned a lot from this guy, and I always go back to his thinking in times like now. And he does address in this month's newsletter that just came out yesterday about, wow, this is a lot of volatility for early in the year, not just because it's the calendar year, but just because it's so much coming at us to really deal with. However, the stock market is still going up, longer term, that secular trend. And when that's going up, you still want to own stocks. And that's what we believe too. But this is a good time to make sure that we're hedged, we're diversified, or we're maybe raising some cash when we have the opportunity to take advantage of volatility and opportunities, because I do think it will continue throughout the year. I think we're going to see ups and downs for a variety of different reasons. Many of them we don't even know right now what they'll be, but we've got to be careful and be ready for that. And so I wanted to share a quote from his newsletter here if I could. Early in my investment career, when the market entered a period of instability, a mentor gave me some good advice when he told me one of the most important things you can do as an investor is, quote unquote, don't do stupid. What he meant was to recognize that there's a time to be aggressive and a time to be patient. Now is one of those times to be patient. We think that's good advice, and that's what we're planning to do for our client portfolios. So thank you all again for being here today. Oh, maybe we have a question. Hang on. All right. Did you list the companies that you're calling dividend darlings? I did not, but we will put those in the show notes in our replay. I've got those built in the chart, and I just made a couple changes, so I want to make sure I've got them right. But it goes to how we're doing more of our portfolio management in-house here at PrairieFire, and we're meeting as an investment committee, going through all the analysts and paid research that we go through, and then we're also using artificial intelligence to sort and siphon through companies so that we can find those that have the strongest balance sheets that are on a good trend, being able to check the boxes using all these new technology tools that are available. So we will include, this recording will go onto YouTube when it's been approved, And in that will include the names of those 10 stocks. So thank you for asking that question. Everybody, thank you for joining us today. We look forward to seeing everybody in person, and we're finally getting a little bit warmer weather, but it was 2 years ago, I think we got 4 snows in April. So I'm not holding out hope that we've seen our last snow, but so far so good. So have a great day. Thank you.
Thanks, everyone.